Hi, folks. This is Big Mike Zlotnik, and this video is the quick update on the latest inflation data. And but before we dive into that, the usual disclaimer: this is for informational, educational purposes only. No advice of any kind, no solicitation of any kind. If you're interested in our family of funds, request PPM, private placement memorandum to accredited investors only. Consult with your attorney and CPA professional before making any investment decisions. So recording this on Thursday, October 12th. Latest data has been released on the CPI, Consumer Price Index, and the CPI rose 0.4% over the last month, and 3.7% year over year, which is in September, which is in line with the previous 3.7% in August. So inflation essentially, the CPI at least, it has flatlined in essence. It's 3.7%. Of course, the Fed wants to see it in the 2 to 3% range. It's still above the target. However, it appears to be at least steady, cooling, and on the core basis, the core excludes core CPI excludes food and energy. September climbed to 4.1 year over year data, and it's a slowdown from 4.3% annual increase in August. So I guess excluding food and energy, which is known to be more volatile, core CPI is cooling. So both of these data prints are generally expected to be positive news, giving the Fed power not to hike in November meeting. So again, maybe it's still speculative. Maybe they'll still hike. We don't know that, right? But we do know that there's enough data supporting the decision to pause and let more time pass. And Fed in the past indicated that they wanted to see more and more data before making further decisions. They did signal that they may do another quarter later this year. However, this data print gives them less ammunition to go ahead and to hike again. Another interesting development is that we've seen a run up in interest rate on a 10-year Treasury, which is one of the most important benchmarks that is used in determination of the mortgage rates. So mortgage rates have experienced run up as a result of the 10-year Treasury run ups, and it impacts all long-term financing for both residential and commercial real estate. As most of the mortgages trade on a spread between 10-year Treasury and the mortgage rate. There's a spread. That spread widens and shrinks from time to time, but there is typically a spread that the banks want to make on the difference, and it's usually somewhere in the 300 to 350 basis points. I mean, it varies. So 10-year Treasury has also retreated somewhat on its yield, retreated from a peak yield just a few days ago at roughly 4.8% down to 4.63%. Now it can climb back up. We just don't know that. But at least in the immediate data, it's all happy data that it's expecting things to be a little bit more steady on the inflation front. No major drops yet, but at the same time, no further acceleration, which is sort of a good news. So if Fed winds up holding steady in November, that'll be good news for a lot of sectors of the economy. At this point, they've done enough damage. And so that's kind of the lay of the land. This is recent news. This is intended to be a very, very quick update. And those folks who believe in the long-term inflation being high and sticky, they absolutely get my respect. And those folks who believe that inflation will come down to the 2 to 3% range and the Fed will have to retreat and ease and turn more dovish, they also get my respect. Personally, I do believe that on a long-term basis, interest rates will come down simply because of the size of the U.S. national debt, and U.S. economy can't really afford these very high interest rates. So that's my view, and I'm sticking with it. But it's on a really long-term basis. In the short run, in the next 12 to 24 months, we may still see substantially elevated interest rates, and that's the that's the that's the reality of a high inflation environment. But the helicopter money is gone. Supply chain has been restored. Of course, we still have long-term adversarial relationship with China, and we're going to be buying less from China on a long-term basis. We're going to do more domestic production, and overall, these forces are inflationary. So you could argue that inflation may stay at an elevated level for many years, and that would be a valid argument. We just don't know. What we do know is that we have more responsible split Congress. So even though we're not looking to balance the budget, but at the same time, the fiscal responsibility is a lot more on people's mind versus helicopter money during the periods of post-COVID. Let's just flood the market with cash. So from that perspective, we're likely going to see somewhat of a slowdown in the inflationary forces. To what degree and how fast, we are watching this. So that's the update. Appreciate you. Hope you have a wonderful day. Until the next time. Thank you.